Welcome back. You're watching Traders Corner. I'm Bronwyn Seaborn, and with me at the desk, as usual, is Garth McKenzie, founder and editor of Traders Corner. Garth, thanks for your time today.
Thanks, Bronwyn. Hi.
So they're calling it Red October, given the kind of pressure markets have been under. So let's take a look at S&P 500 in the context that it is at the moment.
Yes, well, Red October, it certainly has been. It's been a very brutal month, actually, for equity markets. And you can see on the chart of the S&P 500, all these red candles that we have on the right-hand side of the graph over there. This, by the way, is a weekly graph. We normally look at a daily graph in this slot of the show, but I figured let me zoom out a bit and show the weekly graph, because I want to give context to what's happened to the market over the last month or so. You can see the upward trend that has been intact since 2016. That was a very well respected upward trend. It was tested numerous times over the last almost 3 years. But now you can see quite convincingly that that trend line has been broken to the downside on that move below 2,800. Now, the next major support zone is kind of where we are at the moment, or not far below, is at 2,600 on this index. My expectation is that it probably will hold that support level. We are fairly oversold now. Bear in mind, we're down 10% for the month on the US market. So that's what you sort of describe with the definition of a correction. But for me, I think it's worth noting that there's technical damage here that you cannot ignore. That upward trend has been broken. We've seen a lot more volatility this year than what we had seen in the prior 2 years. And I think that this volatility is also a warning shot of possibly more volatility to come, and possibly that this bull market that is now getting quite aged is in its very mature phase now, and possibly that it's actually reached its top. I'll stick my neck out and say I think it might have actually reached the top, but in months to come I may yet eat my words. But as things stand right now, that technical damage to me is worth noting, and I'd be surprised if we go and rally and take out those prior highs. I do think we'll probably get a rally off this 2,600 area, but I don't know that it's going to be strong enough to go and take out those prior highs. Also keep in mind, markets tend to look forward. So, as much as the US economic data right now is still strong, you've got strong GDP, you've got very low unemployment rates, but these are all backward looking. The markets tend to look forward 9 to 12, 18 months ahead. And I think what the market is starting to look at now is what's the effect of going to be of rising interest rates, trade wars, high levels of indebtedness, the end of quantitative easing, etc., etc. There's a whole long list of things we can rattle off. And I think that's what the markets are starting to warn you about now. So that's the S&P 500. I want to also show you the Nasdaq, because this has been the tech area of the market, and the Nasdaq 100 is very laden with tech companies. This has really been the strongest area of the US market that has led this rally over the last number of years. But you can see again here that trend line of the last 3 years has been broken to the downside. The significant lateral support there at 6,500, so I would expect we'll hold that support at around 6,500 in that sort of area. But then, it's quite possible we do get a bounce, and I expect we will get a bounce off that support level. But then maybe we go and form the right shoulder of a head and shoulders pattern or something. We'll need to give it a few more months to play out. But again, the technical damage that's been done over here cannot be ignored.
Here at home, we're not much changed from last week. We're still hovering around that 45,000 level for the top 40 futures at least.
Yes, we've been bumbling around, as you can see, for the last 5 trading days in the bottom right corner of the trading screen here. The market is more or less at the same level. But having said that, there's been some very nice volatility in the midst of that. We had a trading range of 1,800 points on a single day last week. So it's been quite a lot of movement, but as we say, the market's more or less at the same price as it was last week when we were sitting here. Just from a technical perspective, we've said it before, but I'll say it again, the break below 49,000 there was very significant. We also validated a head and shoulders pattern there that was broken to the bottom at 49,500, and that projects down to 45,000, which is more or less where we're trading at the moment. For now, I think what we need to watch is this blue downtrend, which is quite steep. That needs to be broken to the upside, and we need to then see a move above 45,500 to actually open further upside potential. And that would then potentially see a recovery or a little bit of a relief rally maybe into the end of the year.
Of course, leading us, breaking through that 49,000 level was Naspers. And you've picked up some interesting news flow around the company because they're looking at changing the way the MSCI indices are calculated. And that could have an effect on Naspers. So walk us through that detail.
Yes, that's right. So there's some news that's come out from the MSCI, Morgan Stanley Capital Index is what that stands for. And the MSCI indices are very closely monitored as benchmarks for a number of funds, and there's a lot of ETFs that track these MSCI ETFs and indices. The big one that's relevant to us is the MSCI Emerging Markets Index, and then there's the MSCI South Africa Index. Now, what they're looking to do is effectively adjust the weightings of stocks in those indices that have unequal voting structures. So I've actually picked out a couple of lines from a report. This is from the MSCI themselves, which is relevant, and I'm actually just going to read it here. So it says, on the 31st of January 2018, MSCI launched a public consultation on the treatment of unequal voting structures in the MSCI equity indices, and released a discussion paper which aims to serve as the basis of the consultation and facilitate debate amongst market participants. Then they go on to say, under the revised proposal that is put forward in the discussion paper, MSCI would continue to include stocks with unequal voting rights in the MSCI equity indices, but would adjust the weights of these stocks to reflect both their free float and their company level listed voting power. And then following on from that, under the proposal, the weighting adjustment would be calculated the same way for current and new index constituents. However, changes to the weights of current index constituents would be subject to a 3-year grace period. All right, and then they say that MSCI will announce the results of this consultative process on the 31st of October. That's obviously this week. Now, that is obviously very significant for Naspers. What a lot of people may not know is when you look at the share price of Naspers on your trading screen or whatever, you'll always see that it says Naspers N. And you may wonder, what does that N actually mean? Well, what it stands for is no voting shares. That's what effectively you're trading when you trade Naspers on the JSE. And this move by the MSCI could potentially impact Naspers in a very significant way because they have a very unequal voting structure with these no voting shares. And it could mean that over time, Naspers weighting in these MSCI indices gets reduced. As it said in the paper, it would be phased in over a 3-year period, so it's not as if there's suddenly going to be a whole wall of stock that gets dumped onto the market all at once. It would be phased in very gradually. The MSCI recalculate the weightings of their indices every quarter, so you would expect that each quarter there would be a minor adjustment over a 3-year period so that the effect is not that immediate and that significant. But just to give you an idea, currently, if we look at the MSCI Emerging Markets Index, Naspers currently makes up about 2.13% of the weighting in that index. Under this proposal, Naspers weighting would drop to about 0.81%. Right, so that's a big drop. And then in the MSCI South Africa Index, it currently makes up 22% of the weighting in that index. It would drop to around about 9% under this under this proposal. Now, look, I want to just stress this has not necessarily been passed yet. We will find out this week whether or not this is going to go ahead or not. But it's significant because Naspers is our biggest stock on the JSE. And if you do get these weighting changes, it does mean that over the next 3 years, there's going to be this overhang of stock, which gradually needs to be fed into the market. And just to give you an idea of the size of these things, there's $1.6 trillion of funds benchmarked against the MSCI Emerging Markets Index. So, you go and you start talking about 2% of that. It's still a substantial sum of money. So just keep this in mind, and it probably does go to explain part of the weakness that we've seen in Naspers lately. It's not only that, obviously there's been a tech sell-off globally, so I'm not sure how much of Naspers' recent weakness we can attribute to this information, but I certainly would imagine that those funds that have the ability to maneuver before such a decision gets made may have started to move already. Yeah. If we look at the share price of Naspers here, this is how it's looked throughout this entire bull market from 2009. You can see that uptrend that had been intact since 2009 and was tested on numerous occasions over the last 10 years. That has been quite clearly broken to the downside now. The break below 3,000 Rand was a very significant break. And whilst I do think we're very oversold in the short term here and the stock could quite feasibly bounce from these levels, I do expect that it will run into quite stiff resistance when it moves back towards 3,000 again.
So definitely something to keep our eye on, but let's revisit last week's trade, which was Capitec, because we've been stopped out of that, unfortunately.
Well, yes, unfortunately, but sometimes, you know, as we've shown on the show before, sometimes you want to almost say you were fortunately stopped out. In this case, maybe unfortunately, because the share price is now a little bit higher than where we were closed out of it. But one of the reasons why we've done well on this show over the years is that we've always managed to keep the losses small. And it's a very important aspect of trading, is to keep your losses small, because inevitably, if you can get that right, then you're never going to see a major blowout in your trading account. So here's the chart of Capitec. Last week, we went long on 120 CFDs at a price of 983 Rand with a stop loss below 960. And I was looking for the price to break out above 1,000 Rand there, that resistance, and move on to the prior highs, which were at 1,040. Now, as you can see, unfortunately, over the last couple of days, the price did pierce down below the lower trend line, and it meant that our stop loss was triggered. So I closed it out at 958 Rand 70, and it meant that in the end we lost 3,396 Rand. It's a pity. It may yet still go higher. I don't know, but it's one of these situations where the trade didn't work. We don't negotiate with our stop losses. We know going into a trade at what point we're willing to cut it, and that's what we did here. So it's a pity to lose a bit of money, but you know what, if it was sitting down at 900 Rand a share this week, I'd be very happy to have sold it at 958.
Yeah, absolutely. Hindsight's always 2020. So then let's move on to this week. You're starting to look for something for our offshore portfolio. You want to rev it up a little bit, and you're keeping your eye on the S&P 500. So what's that chart telling you that you want to get in there and nibble a little bit?
Yeah, so here's the S&P 500 daily chart now. Obviously, we looked at the weekly chart a bit earlier. That area, that lateral support zone at about 2,600 to 580, that sort of area, I expect that this market will probably find some support in that sort of area and recover a bit off of that area. So what I'll be looking for in the week ahead is some sort of a confirmed reversal and clear evidence of stability in that area, because I do still maintain that we can probably see quite a meaningful bounce off of these levels and maybe even a bit of a rally into the year end. So what I would look for is to either go naked long on some CFDs on the S&P 500, or alternatively maybe get a little bit more exotic and do some sort of an option structure. What I've been looking at for my own personal portfolio is actually to sell deep out the money put options, because you get paid very well for those given the high level of volatility at the moment, and then buy some out the money call options. And then if the market rallies, you get to make a profit on your calls, and you also make a profit on the short sale of some put options. I know it's quite complicated, but if we do decide to go that route, then I'll discuss it in more detail next week.
Okay, well, let's see what happens. But given that we're keeping our eye on S&P 500 and we took a little bit of pain on Capitec, let's check in on the portfolios.
Yeah, so here's our South African portfolio. It's actually at more or less the same level as last week, still up 25% for the year to date. Fortunately, the loss on Capitec has been offset by a recovery in our pairs trade between Pioneer Foods and Zeda. And then our offshore portfolio, we've got nothing happening there. Actually, I'm glad about that at the moment. It's been good to be sitting in cash on this offshore portfolio, but we will be monitoring that S&P 500 for something possibly to do in the week ahead.
Okay, and we're almost out of time, but just remind us about the details of the upcoming course you have.
Yes, on the 17th of November, that's a Saturday, I'm running a full day high probability trading course. It's 1,990 Rand per person, and you include a 1-month Traders Corner subscription for that. So anybody that's interested, please email me, garth@traderscorner.co.za, and I'll send you all the information.
Great, Garth, we have to leave it there. Thanks so much for your time today.
Thanks.
Garth McKenzie is founder and editor of Traders Corner.